Research shows that cutting a position will have a huge impact on your overall profitability. Hey guys, how's it going? In this video, I want to talk about cutting a position. When should you cut a option that you have, whether it's a covered call or selling a put? This is going to be a very interesting video because cutting positions is not really an exact science. And on this channel, I do try to give you more strategies. But in today's video, we're going to be talking more about managing and cutting a position when it makes the most sense. So look, research shows that cutting a position will have a huge impact on your overall profitability. Your profitability really depends on how long you hold the position. That is very logical. But how long should you hold a position? And there's many different strategies out there. So how do you decide on when it's time to just let go of a position that's not working out or a position that has made you good money? At what point do you take profits? Well, the truth is, it depends on the situation. It's really a case-by-case basis. So we're gonna jump into my portfolio right now, and I wanna show you several different positions, from covered calls to selling puts to even some iron condors. All right, so today's actually expiration day. It's a Friday as I'm recording this video, which means that there are quite a bit of positions that I do have expiring today. I'm basically going to be talking about how I'm going to be cutting and managing these positions, because we can actually see here that some positions are negative. So not all positions this expiration have gone perfectly well. So let's just talk about the first one. So when should I cut Apple? So Apple has gone up a lot in value, and currently I have the 215 put. And what I'm deciding to do here is that Apple went down a lot. And I sold 215 puts because I had a lot of covered calls on Apple, and a covered call that's in the money means that my position exposure is reduced. So I decided to sell some puts on Apple because I wanted to get assigned. And in this case specifically, I am actually not going to do anything, because when I sell put options, the goal for me is to get assigned. So in this case, I don't need to cut my position or really do anything. I'm just going to take assignment. Now, in terms of taking profit, let's say that on Meta here, I have another trade that was a small account trade from my Discord community, and we did very well here. This was, although I have a big portfolio, I take chunks of my portfolio and I do small account trading because I want my students to make money. Essentially here, you'll see that I'm up 440, and this option is going to expire today, and I could close out this option, or I can hold it and basically collect $20 more. For me, I'm going to wait one day and make $20 on this position. It doesn't make sense for me to take profit early. I mean, there's only one more day, and I collect the remaining 4.35% on the option. So wouldn't make sense for me. Now, looking at NVIDIA, I made a huge mistake on NVIDIA. I messed up on NVIDIA. So here, oh my goodness. I did not mess up. I'm a genius. The market is not open yet. I'm out in Europe, and I'm recording this 7 a.m. Right now it's 7 a.m. on the East Coast. And guys, this is why I hold positions until expiration, because this was very in the money, and this was not looking that well. I was in fact very upset, because to be honest, I'm successful most of the time, but I'm not perfect. I make mistakes, and I thought this was a huge mistake, and I was very upset about it, because this is a pretty large position that I opened up. I ended up selling this for a good amount of money. Looks like the average credit was 7 cents. And then at some point I lost so much money. Like if you look at the past 1 month, that's basically what happened. So I sold it for like next to nothing, right? And then it increased in a lot of value. So I was going to lose like $6,000 or something like that, which is a lot of money for a small portfolio. This was just a riskier trade than usual, but it looks like NVIDIA is actually going to open up under 130. So I guess my simple approach of just waiting until expiration and being lazy is the best approach. Not I guess, I know. A lot of students message me and contact me, and they get a little bit emotional, which is normal, right, with your finances. But I almost always say hold positions until expiration. And in the beginning of the video, I said, depending on how long you hold your position, it really affects your results. But honestly, I've gotten the best results in just 3 different scenarios. One is cutting a spread when it is 50% loss. So when there's a 50% loss, I cut the spread. That has reduced my risk a lot. Also, when an option goes into the money and it's an iron condor, closing it out immediately has been profitable for me, or much better, and holding options until expiration in all other scenarios. So those are like the 3 key rules. There's a few more. Let's keep going over them. But especially when it comes to covered calls and selling puts, hold until expiration. When it comes to spreads, either use the 50% rule and close it out at a 50% loss, or hold until expiration. I was very tempted on NVIDIA to close it out at 50% loss, but it is truly a coin flip, whether it's going to be profitable or not when it hits in the money, because by definition, when it hits into the money, it's a 50-50. You could either continue going to the money or you can go down. And today looks like I'm in a really good shape with NVIDIA. So for NVIDIA, I'm going to leave it alone. You can see here how I was at a loss of $2,700, but this is actually going to be a complete win when the market opens up, as long as NVIDIA stays below 130. And what I will probably do is I will probably close out this position. I typically don't do that, but because NVIDIA is so volatile, if I see a gain on this position, I will happily close it out. Next, you will see that I have Palantir, and this covered call right here is going for a large loss, but a covered call isn't a true loss because you're losing the stock. You're not necessarily losing this amount of money. So for me, there's 7 a.m. That's why my screen just changed. So for me, when it comes to basically rolling a position or closing it out for Palantir, a covered call, I'm simply going to roll it up. I'm going to roll it from 22, the strike price, to 23. Now, I wish I could do this live. The market is not open just yet, but here's what I'm going to do. I'm going to simply click roll this position, and then I'm going to roll it from 22 to 23. And I'm going to increase it by 30 days or so. So I'm going to go from June to July. This is going to be like a 28 or 29 day period. Robinhood will tell us right now, a 28 day period, as I said. And basically, I'm moving up by $1. So that gives me $1 more of upside here. That is going to give me a net benefit of $1 times 23, which is 23. And then each option is 100 shares. So that's going to give me $2,300 of upside. Okay. For $2,300 of upside, I have to pay a debit of $1,242. That's the total debit. Is it worth it? In my opinion, it's very worth it, because essentially I'm paying 54 cents on the dollar. You can see here how each contract I have to pay 54 cents. Each contract I'm paying 54 cents. And basically for every 54 cents, I'm getting $1 in return. So I'm getting a 2x return for executing this option. For me, that's a very good decision, and I'm very happy to do that. But also, if you want to reduce the debit, here's what you can do. You can just go out further in date. So I can go out to September, and now it's going to be a lot easier for me to roll this up. In fact, when I roll this option up, I'm receiving a credit. I'm getting paid $2,000. I'm actually getting paid to move up this option from 22 to 23. Neither decision is necessarily better. One, you have to pay for the first example I showed you because it's only a 30-day period or 28-day period. So the length of time is very short, and that's why you have to pay. And this example, the length of time is a little bit longer, which is why you get a credit. In the first example, if you do that 3 times, right, 28 days, 3 times is almost 90 days. So it's going to be about the same, right? So the decision here is not that important. Do whatever feels more right to you. And I always tell this to my students. I teach them all the strategies. I teach them how I think about managing each strategy. But at the end of the day, there are no right answers in the stock market because it's not an exact science. It is a mix of science, math, and art. So for me, if I had to make a decision, I would probably go out a little bit longer because I am lazy. I'm a lazy investor, and I like that I'm a lazy investor. I like making safe passive income and not doing that much work. I like relaxing. So for me, I like to trade options a little bit further. And as time goes on, I like to trade options that are further and further in date because it's nice to just get passive and safe income. Shorter term trading is more fun and it gives you more experience. So I do recommend that beginners do shorter term trading, 1 month, 2 weeks. But at the end of the day, you are directly compensated for the time. So whether you make $2,000 in 2 weeks or $6,000 in 6 weeks, your capital does dictate how much money you will make, as well as the market condition and the market sentiment. So if the market's up 10%, you are probably going to make about 10% if you have stocks that are similar to the S&P 500. Now, if you have a lot of single stock exposure into interesting companies, then you're going to get different results. But you get what I'm saying. You're going to get the results very similar to time and very similar to the market. From there, you can do better than the market if you make smarter decisions, if you're using technical analysis, if you're using all the stuff that I teach on this channel. All right, you can have better results, but your results are not going to vary that much more different than the stock market in the short term. Okay, it is a long-term game where you can see a very huge difference. In fact, in the short term, 1% difference is going to look like this, right? It's going to be like, let me start over here. Okay, it's going to be like this, and as you move, a 1% difference creates a very big difference, right? So imagine flying. Or imagine walking 2 meters, it doesn't really matter. But if you're flying at a 1 or 2% different angle from Philadelphia to California, you're gonna end up miles apart, even at a 1% degree angle, because over time it right? You get what I'm saying, right? Geometry. Same thing with the market. It just follows basic math and stuff. All right, so yeah, basically that's that. The next stock position I have to make these videos entertaining, guys. I've been at it for 5 years, so I love doing this, and I like to keep it entertaining because I think making more entertaining content and having a good time will help you learn. So if you appreciate that, drop a like, drop a comment. I would appreciate the love and the support and a subscribe. So that'd be awesome. I do have QQQ right here. So this is going to be the same case as Palantir, except actually in both cases, I definitely don't want to lose a stock. So today is going to be my roll day, because if I lose a stock, I have to pay taxes. And on QQQ, you will see here that I got to sign the Sana shares, but you will see here that on QQQ, I have it at 456 and I'm up $2,000. Not a lot of money, but if I end up losing the shares, I will have to pay some taxes. So what I personally like to do, and I don't advise on taxes, I'm not a financial advisor. I'm definitely not a tax advisor. Definitely not. Actually, fun fact, I had a job as a tax advisor. I'll give you a little bit of quick story here and we'll go back into managing a position. But I guess this has to do with managing your life. I had a choice when I was in college, when I worked at a hedge fund trading options. I had a choice to go to another hedge fund trading options. However, because I was interning, one job gave me the opportunity to make $13.50, and the other tax job gave me an opportunity to make $22 an hour. And broke Henry, who had no money back in the day, and I wanted to grow my option portfolio as fast as possible. I was 19, maybe 20. I took the job that gave me the $22, even though it's tax accounting, which I absolutely hate. I hate taxes and I don't even understand them. And what ended up happening was I was so lazy at the job, and all I wanted to do was trade stocks and options. That's all I did. And because it was a tax job, I could trade stocks and options. When you work at a hedge fund or a financial institution, you can't do that. You have some restrictions, right? So I ended up trading and not doing my job, and I ended up getting fired after I think 3-4 weeks. I was a really bad employee. So I ended up getting fired and making less money. So long story short, don't take jobs just for money. So it doesn't really work out. But when it comes to taxes, I'm not going to advise you on taxes. Always contact a tax professional. But when it comes to selling a position, I try not to sell positions because you incur taxes. So once I have a gain on a stock, I just try not to sell it. So if we look at my stock positions right now and I change to, let's say, total return, you'll see here, if I have a gain, I'm really not trying to lose it. And on Palantir, I have a good gain, so I'm gonna have to roll that position up. On QQQ, I have a gain, so I'm gonna try to roll that position up. American Airlines fell, so I'm kind of losing on that. Confidence gonna pull back up, and I made a lot of money on options. And I think I just got assigned on Asana today, which is the risk of getting assigned early when an option is very deep in the money. You can actually see here, it's pretty interesting. I had, what was it? I think I had several contracts here, and not all of them get assigned, so it looks like some are still available. Or actually no, all the June ones got assigned. So yeah, I have 600 shares of Asana right now, and this is an example of the wheel strategy. I got assigned here. I could have rolled this position lower. I didn't want to. I was fine getting assigned, and looks like I have 600 shares. So I'm going to be selling covered calls now on Asana and just basically collecting some income. I wanted to mix up my portfolio. As you see, when I try to mix things up, it doesn't always go that well, and that's why I like to follow a small amount of stocks. It's much easier to manage and not take profit. I guess the point of this video is I don't take much profit. I literally let my stocks run up a lot in value, and then I like to roll them higher and higher. So when it comes to taking profit or closing a position and managing it, I think that closing a position at 50% is really good for spreads. I think for an iron condor, it's closing it out as soon as it hits a break-even price, or it hits in the money. And then for everything else, you just wait until the last moment. So for NVIDIA, I wait until the end. So anyways, that's my management strategy. It obviously is a lot more complex than this. Managing your trades is, each situation is a case-by-case basis. It really is, and there's no right answer. So that's kind of why, I guess, as a coach, I'll always be around, because each situation is unique and everyone needs to learn from themselves what works for them, what feels right. I guess it's very similar to your emotions, how you manage your emotions. It also depends on your portfolio size. If you have more money, then it's okay to get away with certain things, or if you have less money and you don't care, it's also okay to get away with certain things. There's no optimal strategy. I mentioned the 3 strategies that I use, basically the 3 rules that I have. Yeah, it really depends. So if you'd like any coaching or just connect with me, then check out the description, and hope you guys enjoyed this video, and I'll see you guys in the next one.